Good day, folks. It's Jim here from Orchard Forex. It's Saturday the 21st of August. And the stock markets rallied. The US dollar eased back a little on Friday, mainly because the Fed's Kaplan, previously hawkish, seemed to ease back somewhat on his desire to commence tapering perhaps as early as October. He recorded a TV interview and was a little more cautious perhaps. And the stock markets and the dollar took note of that. The stock market still closed with weekly losses, but they did recover well from their lows. And the US dollar, that gave back a little bit of ground on Friday, but the dollar index did close generally about 1% higher over the course of the week. So the dollar had a good week. Euro and sterling both took a bit of a hit. They were the leaders really in the dollar index. The Aussie and the Kiwi actually fared worse. The Delta variant is pretty rampant throughout the east coast of Australia, and it's also caused a lockdown in New Zealand, so that helped the Aussie and the Kiwi lower. And also it should be noted the iron ore price dropped almost 15% last week, and that hasn't helped Australia's biggest export. So it helped cause the Aussie to head a fair bit lower through the end of the week. Traders are now looked to Jackson Hole, which it was announced on Friday is now going to be a virtual meeting, suggesting that the Fed remain pretty cautious, and that could possibly mean something as far as tapering goes. Maybe they will delay tapering, which could cause yet another rally in the stock markets and perhaps a bit of an easing in the dollar. But that'll take place on Thursday, Friday, and the Fed Chair Powell, he will be giving his economic outlook on Friday. So really all eyes, I think, will be on that through the week. Ahead of that, there's bits and pieces out on the calendar. We've got the PMIs, the flash PMIs on Monday. We've got the German GDP Tuesday, the German IFO, and the US second quarter GDP on Thursday. But really all eyes are going to be on Jackson Hole from here, I think, and on Powell. Also, it should be noticed that oil took a big hit during the week. That lost quite a bit of ground, and that's all to do with the Delta variant too, I think, and the concerns over economic growth. Anyway, we'll find out more during the week, and really all eyes will be on Friday and what Jerome Powell has to say. But in the meantime, we'll go and have a look at the chart, starting as usual with the dollar index.
Okay, folks, so here we are. We start off with a daily chart of the dollar index. And this red bar here, this is where we finished previous Friday. We mucked around on Monday and kind of regained some ground on Tuesday, but didn't really take out the previous highs. Then Wednesday did very little. Thursday was the FOMC minutes, and we really have started to motor higher, taking out this high back here from March, closing pretty much right on it though, at 93.5, which was a level we've been looking for quite some time now. So extending further forward, if I close this daily chart up a bit, so here we are, this the March high. If we are going to keep continuing to motor higher, this 94.30 and 94.70 levels, they're both going to be pretty important. And it has to be said, the daily indicators, which were this time last week, they were pretty flat, not showing us an awful lot. They have moved into positive territory now, and coupled with the weeklies, which I'll show you in a second, I suspect we're going to have further dollar strength ahead of us, eventually taking out this high, moving on to these levels. But it has to be said, of course, much depends on what Powell will have to say on Friday, and if he maintains his hawkish stance and that tapering will commence sooner rather than later, we're going to see the dollar move higher. If, on the other hand, he's slightly more dovish, more circumspect because of the Delta variant, then we're going to see the dollar ease back. As far as the weekly indicators are concerned, we're just going to have a look at those. They remain quite firmly to the top side. And as far as the FIBO levels are concerned, if we take out these levels, then where these two highs are here, that ties in with the 38.2 FIBO level at around 94.5. So I guess that's our ultimate target, and notably the 100 and 200 day moving averages sit at around these levels as well. So while I can see the dollar does head higher, I think it'll struggle if we get towards that 94.5 level. There'd be plenty of resistance there. Sorry, those are the weekly moving averages, not the dailies. I'll just go back and have a look at the dailies. If we come back below this neckline, this level is going to be important on the dailies. 92.5, which is in line with last week's closing level. And if we go below there, then we head back down to this sort of 91.40.50 level, and that would equate to around 119 a quarter in the euro. So with that, we'll go and have a look at the euro and see what we think of that. Okay, we'll start with a 4-hour chart of the euro. It seems to have found a little bit of a base down around here at this 116.60 level. Closed back really at 117, sitting right on this pivot really that I'm kind of watching. And I think if we move above there, we can head a bit higher towards sort of 117.5, 118. We've got some minor bullish divergence here on the euro, so a little bit further upside wouldn't really surprise me come Monday, Tuesday. Don't forget we've got the PMIs out of Europe, so that'll give us some direction in early European trade on Monday. Now if we go and have a look further forward at the daily charts, and as you can see, the euro finished right on the 38.2% FIBO retracement level, so just about 116.90, but below the neckline that we've been watching for really quite some time now. We did have an attempt to get back above the neckline sometime there was previous week, but it failed and has come back down here, finishing just above the lows. Now the daily charts are pointing somewhat lower. The weeklies likewise, they might be winding up for some downside momentum. So as far as the weeklies are concerned, the 200 week moving average, that comes in at 115.5, still some way off, and the 50% pivot of this whole move, that's at just under 116. So that would be a downside target. I don't think we're going there early in the week, and as I say, much depends on what Jay Powell has to say. But the daily charts at the moment and the weeklies do suggest we have got further downside potential, while the 4-hourly charts suggesting that maybe we've got some minor near-term upside. So selling into rallies to around maybe around this high here, 117.40 early in the week, maybe a bit of a play. And if so, you'd probably keep your stop loss above 118, which is this high here, 118.05. I prefer to be long US dollars given the look of the dollar index chart on the dailies and the weeklies. So looking to sell euro into rallies, sell sterling, sell Aussie, Kiwi, because I do think ultimately we're probably going to take out this low here in the euro and head back down towards that 116.5 or 116.60, this low here, and eventually down towards 116, potentially even 116.5. Going forward to look at dollar yen, which really I'd avoid. It's pretty choppy. We've got highs up here above sort of 110, 110.5, 110.75, and we got lows down here below sort of 109, and in between. Oh, it's quite a decent range, and if you want to trade the short-term ranges, that's cool. But for me, this is just too choppy. There's no directional movement in it, and if you're going to trade the yen, I suspect doing it through the crosses is probably the way to go. The 4-hour charts, as you can see, are absolutely flat. The dailies likewise. So I just think there's better things to be looking at on the board. We're sitting pretty close to this 100-day moving average, the blue line here, and it wouldn't surprise me at least until Jackson Hole to see dollar yen hug this line. And as I say, if I was going to trade it, do it through the crosses. Sterling. Okay, here we have a 4-hour chart of sterling. This time last week it was carving out a move in this sort of area, and we were wondering whether potentially it was a bull flag. It most certainly didn't turn out that way, and we've come down quite steeply here, and we're sitting above the July low, around 135.70 or so, and it looks to me that the 4-hour charts are a little bit oversold, potentially forming a bit of a base. So like the euro, I wouldn't mind selling into short squeeze on the top side, probably I guess anywhere between sort of 136.75 and 137, because the dailies look as though they're heading for the downside, and the weeklies, they also seem to be looking a little bit heavy to me as well. So go back to the dailies here, and we've got this kind of neckline. I don't know if it's a head and shoulders or not, but if it is, the neckline, if it is, it's sitting right on the 23% FIBO support at 135.65. If we go through that level, then there's not an awful lot. We get down to sort of these sort of lows down around here, 134.5, and then below there it's really opened slather down to 131.5. Long way off at this point in time. I guess these highs back here will provide some support. That's around 134.80. But sterling does look a bit precarious to me, and I think selling short-term rallies is probably the way to go. If I was to sell, I guess the stop loss would probably be back somewhere above this, or 137.5. Ideally, I guess about 137.80. I don't think we're going up there. So looking to sell into this area here, if we see it this week, with a view to breaking this low here and eventually heading lower, that would be my game plan. The Aussie. Okay, the Aussie, and here we are with the Aussie. Now, this time last week, the Aussie was actually at 73.70. Hard to believe now. But it did pretty much as we thought. Once it cracked this trend line support, it's come down really pretty hard, basically because of COVID and also because the iron ore price is not helping the Aussie. We're now pretty much oversold, so we could see a little bit of a bounce, and we may head back towards 71.80, 72 cents. I think if we get there, that's probably a sell. If we look at the daily charts, they're looking pretty precarious, and I suspect eventually we're going to move to this sort of 70.40 area and see what goes on around there. We've also got, let me blow this up a bit, we've also got these lows down here. That's at 70 cents, so maybe we do head there eventually. The weekly charts equally look pretty precarious. We're struggling to stay above the 100-week moving average, having cracked and easily cracked the 200-week moving average last week. We're sitting on the 100-week. If we go below there, the long-term FIBO support, that comes in here at sort of 70.50. So that, or 70.45. So that's a level to be looking out for, I think, is where I'd be taking some profit. But I'd certainly be looking to sell into rallies. We might not even see a rally early in the week. Here we are with 4-hour chart again. Yes, if we saw 71.80, 72, I'd definitely be looking to knock some out there, because I think eventually we're going to see another leg to the downside. Pretty similar with the Kiwi, I think. The 4-hour charts on the Kiwi, here we are, here we have a 4-hour chart. They're potentially showing a little bit of a bounce ahead of us, but really if we got back up to the previous lows, these lows here, 68.80 or so, I'd be looking to sell. The RBNZ had been expecting to hike rates last week, and of course because of COVID and the lockdown that's come about in New Zealand, they didn't, and that's sunk the Kiwi to a certain extent. And the daily charts, like the Aussie, are looking pretty heavy. The weekly indicators are looking pretty tired as well. We've got this 100 and 200 week support down here for Kiwi around 67.5 to sort of 67.20 area. I'd be looking to take back some down there, because we've also got this FIBO support 67.05. So as far as rallies go, as I say, if we saw it at 68.80, I doubt we're going to see it up there, to be honest. But between 68.5 and 68 3/4, I'll be looking to sell it with a view to taking it back 67.50 to 67.25 level, something like that. Okay, that's probably enough on the currencies for the time being. So we'll move along to the stock markets, and here we have a 4-hour chart of the S&P. That had a pretty heavy week. It was looking a bit precarious, really, but we saw a good bounce on Friday, and the 4-hour charts to start the week are looking pretty positive. So I think probably buying dips on the day may be the play, but further out, the daily indicators still look a little bit heavy, and the weeklies, as they have been for several weeks now, probably a couple of months, they retain their overbought position. Although it may be that they're just unwinding a little bit, but it doesn't stop the possibility of being quite a sharp sell-off if the Delta variant takes off and economic growth really looks as though it's going to slow. If we go back to the dailies, you can see that the rising trend line, we came back to meet that almost perfectly. Actually, let's go to the weeklies again and blow that up. So we do continue to hold above here, and that's at 43.5. I really wouldn't want to see a weekly close below that line, I don't think, because I think then we possibly could start to motor to the downside. But in the meantime, things still look okay. There's no point in fighting this trend, so just go with it and raise your trailing stop accordingly, I think, is the play. On the dailies, the all-time high here, 44 3/4. If we can take that out, I think for the big first part of the week, we're probably going to just thrash around in this area here. But depending on what Jay Powell has to say, we're either going to take out 44.80, 44 and 3/4, or we're going to move back below this 43.5 level. And I think if we do move lower, it's probably going to be quite a sharp move. If we move higher, it's probably going to be a bit of a grind, as we've seen in the months gone by. So we wait and see on that one. But like I say, I still prefer to trade it from the top side and raise my trailing stop as the market grinds slowly higher. The ASX, I'll have a look at that. And here we have a daily chart of the ASX. That had a pretty tough week. I had 4 losing days in a row, I think it was, mainly because of COVID. We're all locked down here in Eastern Australia. And the iron ore price, as I said earlier, that hasn't helped at all. But it did manage a decent rally off its lows on Friday, closed just below 7,500. And the daily charts still look heavy, so I haven't lost focus on the downside. And this sort of 73.5 level is going to be important. If we go through there, I guess we can head back to 100-day moving average. That's 72.25. But on the top side, the 4-hour charts actually look quite positive for Monday. So we could crack, if we can crack back above 7,500, we could possibly go and test this level here, sort of 75.30. And if we get above there, then I think maybe 75.80. I don't really think that's likely early in the week. It wouldn't surprise me really to see 3 or 4 days of just thrashing around here ahead of Jackson Hole, and then we take our direction from there. But for the time being, as with the US indices, as long as we remain above the rising trend line here, it's sort of 73.5 level, 73.60, whatever that is, I prefer to be long. On the downside, if we crack this sort of 73, this is the 61.8% of this move here. If we crack 73.5 to any great degree, then I think probably get out of it for the time being, because we probably see more downside. Let's go have a look at gold. Okay, so here we have a 4-hour chart of gold. And it had a pretty choppy week without doing a great deal. It had a decent rally early in the week, and then just sat around this sort of 1780, 1790 level, really trying to make up its mind whether it wants to break back above this previous support, now turn resistance. As it happens, it's kind of finished right on it. The 4-hour chart's pointing a little bit lower, but doing nothing dramatic. The dailies are equally pretty nondescript as far as directional bias goes. So my view would be buy it at 1750. But if we get to this sort of 10, 15 level up here, I'd probably be out of it. It can go up to 1835 and still not break the recent highs. But it doesn't look like doing that early in the week, at least, and we might have to wait for some directional bias from whatever Jay Powell has to say. In the meantime, just a range trade, call it 1750 to 1810, and trade it accordingly. Oil, here we have a 4-hour chart of West Texas, and this was the support line last week, and we were sitting above that, the blue line at $65. As it happened, we've broken quite cleanly through it to the downside, and we've now come back. We've got a double bottom with this low back here from May, and sitting above these lows from April. The 4-hour charts look very heavy and seem to be pointing lower. The dailies likewise, the weeklies also. So really it seems to be a no-brainer to be trading oil from the short side at the moment, with resistance probably back at this 65 level. That could all change, of course, if Jay Powell is upbeat about the economic outlook. Well, oil could see quite a sharp turnaround, but at this point in time, I don't really see that, and I'd be looking really, I suppose, now for a move back down towards $60, possibly a little bit lower. But through the week, what are we going to see? Probably not an awful lot, and some choppy trade around these levels, but with a selling bias. I'd be looking to sell it at these highs here, sort of 63 3/4 or so, with a stop loss above 65. But looking to take profit and probably be square ahead of whatever comes from Jackson Hole on Friday. So that's probably winds it up for this week. We'll have a quick look at the calendar. Okay, so here we have a calendar for the 23rd, and as you can see, it's going to be a busy day throughout because we've got the flash PMIs due to be released, starting with Australia and then moving through Asia, Europe, and into the States. Tuesday, it really goes all pretty quiet after Monday, to be honest, until Friday. We've got the German GDP, New Zealand retail sales for those who trade the Kiwi, and some. We've got the Richmond Fed Manufacturing Index and some US housing data. Wednesday, some more New Zealand data, the trade balance, and really that's about it. We've got the German IFO, and we've got the US durable goods. They'll be quite important, but I don't think the market's going to take an awful lot of notice of them because we're waiting really for Jackson Hole Thursday. Jackson Hole starts, and that aside, we've got the PCE figures and of course the weekly jobless claims, as well as preliminary Q2 GDP figures to be announced. And then on Friday, Jackson Hole continues. We've got the Australian retail sales. They'll be interesting, and that's really about it. But don't forget, at the end of the day, we've got Jay Powell speaking on his outlook for the US economy, and I think the whole week is going to hinge on that really. So ahead of whatever he has to say, it wouldn't surprise me to see a pretty choppy direction this week. So we'll wait and see. But we'll be back with another video next week. In the meantime, good luck with your trading, guys. See ya.